Okay, guys, I'm very excited today to bring on Rory, who's been on before, and we're going to skip his bio for the time being. We're going to let him crosstalk a lot further in the episode. But we have a very special guest, Chris Bay from EDG. Chris is a long-time actor in the traditional financial space and has a lot of experience. And, given the current environment, I'm obviously not typically a macro or TradFi podcast, but I thought this would be a good opportunity to talk to people who are just given current events, and this will be sort of my version of a macro or monitoring the situation podcast, if you will. So Chris, welcome. Thank you for coming on, and if you don't mind giving a bit of background.
Thanks for having me. Super excited to share this time with you guys. As you mentioned, I founded Enhanced Digital Group as a U.S. onshore trading firm for digital assets, particularly commodities, Bitcoin, ETH, so on and so forth. But I spent too long in traditional finance, where as a macroeconomist, I jumped on the Goldman Sachs trading desk all over the world and kind of bringing to light recent of current events. Was on the trading desk, in London when 9/11 happened, when the invasion happened. Unfortunately, been on the trading desk in macro currency derivative roles around the world. When North Korea launches a missile into the Sea of Japan, I was based in Tokyo. So, as current events goes, I hate to say that this is par for the course, but, history definitely rhymes if it doesn't repeat. So can kind of seeing all these aspects. My tour of duty went around the world twice as a global currency trader. And then it evolved as currencies was one of those macro asset classes that actually got electronified very early. And that's a huge reason and understanding of why we got into digital assets. So after my sell side career, I was a prop trader at a hedge fund, and then I went to UBS Asset Management, which I was head of asset allocation for a $40 billion alternative investment vehicle. Maybe some of your listeners are familiar with it. We did everything. We went anywhere. We did anything. We did fund investments, co-investments, direct trading, and we just had a unique aperture into the world. Definitely dabbled a lot in macro investing, my background, but other idiosyncratic alpha opportunities, which is where I fell into digital assets professionally. We got aggressed by people like very large endowments, sovereign wealth funds, who during the token days and the ICO days, and then into COVID, got a lot of in-kind distributions from the VC firms. And these are clients that I've known from my past life who said, you kind of helped us manage really volatile things in the past. We just got a huge distribution from this VC firm in a token that we've never heard about. How do you help us monetize it? How do you help us hold it until the lock period finishes? And so that was the beginning of my professional digital asset journey, where I scratched at the market structure and started understanding things that really resonated with me. The market structure was developing so fast. Spot liquidity was really insane at that time in the market. The rates market and the lending market was being built. And so if you have those two things, if you have an interest rate market and you have a spot market, I can trade and create options markets. I didn't need a derivative. I can just trade them myself and synthetically hedge them and do what I need to do. So that was kind of the genesis of Enhanced Digital Group and my journey into it. But to keep a long story very short.
Okay, fantastic. And then Rory, just now a little bit of context as to maybe how you guys know each other. By, again, goes to the original episode, but for a very high level overview, Rory basically manages all of the trading and risk management for CleanSpark, which is a miner. So this is short prop. The actual mining side, you are oftentimes using derivatives, options, all sorts of financial products, looking at your balance sheet and figuring out ways to keep a business running from a financial perspective. So my assumption is you guys work together in this capacity. But yeah, maybe give me a little bit of context as to like how you guys know each other and the impetus for this podcast, perhaps.
Yeah, absolutely. And just to put a point on it, appreciate it. I know Chris will say this as well. Everything is obviously a huge team effort. So I do lead our digital asset management side. We're responsible for the treasury management specific to the Bitcoin hodl. We have a little over 13,000 Bitcoin. I think about 13,000, around 300 right now. We manage the spot sales program out of our group. We manage derivatives overlay on it. We lead some of the Bitcoin backed financing side of things, and then look at some other idiosyncratic stuff as well, which I'm excited to talk more about, I think, in the future. As to how we know each other, I was introduced to Chris when I first started at CleanSpark, but it turns out, like a lot of things, just like we were talking about in the green room before, we all kind of know each other. What's funny and what has been really interesting to me about, as I went through the kind of TradFi, I like that you called it a tour of duty, Chris. I call it the meat grinder. As I went through that my own self, you have your own viewpoint of it when you're in it, but as I kind of went outside of it and have sort of come back in a slightly different way, I have just a really great appreciation for how small the industry really is, the relationships that have been durable over many years. And Chris and I's relationship is one of that, was sort of adjacent. I think we knew each other through Key Comfort Discovery, which was the hedge fund that I was at, knew some of the people over there. And so when we came back, I was introduced to Chris as kind of, he's got kind of TradFi background and again, we talked about it. I think, I say this, we try to at CleanSpark try to bring a distinct maturity that's maybe at times not always been part of the space. And I think that EDG was bringing that brand with that kind of US kind of onshore risk management, kind of TradFi root side. So I immediately clicked with their team. And then of course it turned out that we kind of knew a bunch of people and had a bunch of kind of similar background on the macro trading and TradFi side. And Chris, tell me if that's fair.
Yeah, no. When I talk about how people manage volatile assets, I mean, your former role and Discovery Capital, I mean, they are at the tip of the spear in the hedge fund world of managing highly volatile times, highly volatile assets, and doing a great job in portfolio construction and management. Now, these are like esoteric words that actually mean something. And so when Rory met CleanSpark, the team felt, this is a client we want to cover here. This is exactly in our wheelhouse. How do you feel in high vol moments, with a balance sheet that you're supposed to do something with during uncertain times? So it was kind of like, we both sought each other out once we knew each other were in this space. And it's been great to get to know Rory in this professional capacity, certainly.
Yeah. Okay. So just since we're a little bit on the topic of mining specifically, talk to me a bit about this kind of maturity of miners here. And I know you talked about all sorts of different kind of products you provide and can structure, with regards, lock tokens and so on and so forth. But, originally my understanding is that options kind of took off with, or, I don't know if it was kind of chicken or the egg, but with Bitcoin miners specifically, right? Giving them ways to hedge. But I think that it is much more mature now. And like you can see this in practice, right? We have Rory, who's like this hedge fund trader, previously is now working at a Bitcoin miner. This was probably not the case, I would say, call it 10 years ago, right? It was much more the Wild West. Talk to me a little bit about, like maybe the trajectory and a progression. Like, what were you seeing? And I assume this kind of is, part of the reason that you started EDG as well. But like, talk to me a bit about that original time when, it really did feel like the Wild West, and you had all these miners doing sort of crazy things, and oftentimes, doubling down instead of hedging risk, right? They were wanting to long. So yeah, like maybe just because we're on that topic, give me a little bit of a brief history there.
Yeah, I mean, just in general terms, I think you nailed it. I think, there's a saying in commodity trading, hedge, you lose your edge. That's the old school Wild West thought process. To your point of doubling down, it's called the Texas hedge. You just buy more of whatever is going on. So, there's a bit of that. There was a bit of that. Plus, you had a lot of companies whose investors wanted that beta. There was no IBIT. There was no Coinbase direct access. Yeah. And so that beta, right, portfolio management and expression, that beta was through the miner stocks. And so you had this evolution of capital formation, which I'm sure we'll get into later, of how do I get exposure to this asset class? And the miner stocks were that. So you had a C-suite level executives knowing that that's how they did capital formation, and that they weren't wrong about that. But as life went through, and this is what we really do at EDG, we don't mine, but we try to get behind the curtain as to what's driving your balance sheet economics. And unfortunately in mining, as Rory knows too well and helps educate even us, is that there are things that you can't control. There's a community aspect called hashrate. There is energy costs. So we try to work with people who understand their PPAs, cents per kilowatt hour, which region, what kind of curtailment, because curtailment is an energy option that they might have. And we try to come through, okay, how do I put myself in Rory's shoes? Gosh, that's a hard problem. Summer's coming up. Energy costs are very high. What are the right treasury solutions? Because he's got other things to do. And so what really resonated in the post FTX world were I got to meet payroll, and payroll's not in Bitcoin right now. Payroll's still in dollar cash. Oh, I have to pay my electricity bills. The utility wants dollar cash. They don't want Bitcoin yet. And then, the S17s just got downgraded. The S19s are coming out. The S21s are coming out. I got CapEx upgrades. That's not even expansion yet. That's just running on the treadmill. And so we said, hey, if the first few years of our life was very lonely, we're just talking to the wall, and then all of a sudden, people are like, you actually understand my problems. And so we realized it's a hard one. Just status quo is very hard. And here's the solutions that we're thinking about for Treasury Solutions for you as it relates to how to help that treadmill not increase speed, not increase incline, and just so you can run faster and more productively. So that's kind of how it started. And then with the FTX era, which was really volatile for all of us, boards demanded more from their executives. And so you saw an evolution of the C-suite and the institutionalization of, hey, your shareholders actually, I say investors want two things always. They want predictability returns and transparency returns in general. They'd love both. They'll take one or the other. And then all of a sudden, these shareholders during the FTX eras really wanted that. And so you had boards demanding more of their C-suite, which was really challenging on them. And we try to help elucidate those goals and try to shore up their stock prices in different ways. And we think more is more. We think there was a couple big miners out there in their 2023 10Ks that you can read that really grabbed a hold of hedging. And that, I think, is when it really took off.
Do you work primarily with American miners, out of curiosity?
We have a fair share of US miners. That's true. And we also work with international ones as well.
Okay. And then just since we can finish up on kind of like a mining specific topic, what is, maybe give me, and I'm sure I asked you this before, but give me the last 5 years of mining and consolidation from both of your perspectives. There was again, when I first got into Bitcoin, it wasn't super early, but it was still in that period of kind of Wild West, and it very, very much has changed, at least from what I see on the outside. Talking about the state of mining, long been discussion of the viability and sustainability. And yes, now you have professionals like hedge fund traders who are, managing balance sheets, and you're not taking on all this exorbitant risk. And, it's kind of insane as we look back on to see all these miners who were just levered long and just assumed that Bitcoin would go up in perpetuity, right? and they had loans against all of these, machines and warehouses and whatnot, and got wrecked. Talk to me about maybe the current state of mining before we move on.
Yeah, I'm happy to jump into that just because it does seem like
either one, I guess.
My wheelhouse. Going back to, and I think you're going to get this a lot from me and Chris. I tend to be in aggressive agreement with him on most of these topics, but he's, again, I think this is great because he's coming from kind of the dealer side on a lot of this stuff. We're coming from kind of the corporate kind of firm side, but we're seeing a lot of the same things. You talked about the evolution, and I think that you can break it down, if I was going to do it really quickly, into kind of 3 different regimes. And I think this is really important to understand, which is that the market also demands and rewards different things during different periods. And, and every business will have to, every successful business, we talk about this a lot, is going to have to basically burn itself to the ground and rebuild itself in these new regimes as you go. I saw it at Discovery. I saw it, Rob's background when, it was EM, he started the EM desk at Fidelity in 1993. He traded the Brady bonds in Mexico and kind of did that whole thing for many, many years. And, then he was at Tiger. And then kind of as I joined later on, we were moving into more of a full on one to the capital was going, and then macro was becoming a much bigger thing. And then we moved into kind of post GFC to become kind of a QE. Liquidity really was driving stuff. And it was less about esoteric, EM stuff. And it was more about kind of big thematic trades. And so I think so to apply that to mining and Bitcoin specifically, I think that you have kind of a wildcat era. I think you had a market share era, and I think we're now in a margin era. And I think that the wildcat era was exactly what Chris talked about. It's, hey, who's brave enough to go out there, plug some machines in, and you really could show up somewhere in the middle of nowhere and find a plug and put some ASICs in and start routing it to wherever, man. And if you were getting that Bitcoin and you were kind of riding that wave and you had that kind of risk tolerance, you could really kind of make a fortune during that period, make and lose and make again kind of a fortune during that period. Then I think what we saw was, and I think you're exactly right, then two things happened. I think we moved a little bit where the asset class started to mature a little bit, and pubcos really started to kind of come into their own. And so then what you saw was two things. You saw both the market recognize that this is the way to get, securities exposure kind of through a traditional securities account to Bitcoin and all that upside in technology, while at the same time you had just an absolute, it was really kind of, it was a very competitive landscape to kind of take market share. And so you had access to capital markets. You were really on the treadmill from a CapEx perspective. So you needed to invest in CapEx, and you needed to take market share as much as possible. And that created some very difficult conditions for capital formation and return on equity capital, quite frankly. And I think that what we saw is we're seeing finally a little bit of a rationalization of that. And I think it's taken a long time. And one of the things I've been, even before I was with CleanSpark, I was very interested in them because I think they've always taken a very, very kind of counter-cyclical kind of tortoise and hare approach to these things. And, they were really great about at the top of the last bull cycle. They said, hey, we know that where things are great. And if we sell it 65K, 70K here, we're in a really good place for kind of this next cycle. And they did that. And then kind of as we kind of bottomed in June 2023, they started to kind of add that hodl back. Now that tortoise and a hare, though, was not rewarded by the market necessarily at different times, right? And you saw these boom bust cycles. And going back to your point, Chris, about what boards are demanding and what shareholders are demanding, what they wanted was, you come out with a big announcement, you print a big ATM, you dilute, and we're going to get the machines in 6 months or a year, and we're going to price all that growth in now. And so the stock prices really, I think, priced in that kind of that cycle, whereas the enterprise values of the businesses and the return on capital, I think, has taken a couple years to rationalize a little bit. And so we saw the booms, we saw the busts, and this is not a knock on anybody, and it's certainly not meant to be, but I think that those business models that really ran out ahead and kind of created a headwind to kind of returns on capital have been very challenged in the last 6 months, certainly kind of 6 to 12 months. We've seen people kind of start to move off things. So I don't think it's just the AI story that's taking people out of this space. I think it's that kind of that boom bust cycle is also having an effect. It's certainly both, at least. And then lastly, we're getting into the margin era. And I think we're even seeing this, at CleanSpark, which is that, for us, it was always about operational efficiency, uptime, and what we wanted to be was that we always want to be the best operators possible. And just, more recently, we started to talk about just not that margins have ever not been a focus. Of course, they're a focus, but it's really about, hey, we're in a stage where we're thinking more about that curtailment. We're thinking more about those energy options. We're thinking more about how does digital asset management optimize the return on every single Bitcoin that we generate. And so I just think it's a more holistic space now. And quite frankly, it's a good thing. It's good to see maturity. I think it's good to see a focus on these types of things. And I ultimately think that the market will come back around. I think, Bitcoin's a little bit out of the meta right now. And I think just in general, but I think as the few companies that have really kind of stuck around and thought very thoughtfully about long-term investment, business cycles, optimization, and margin, I think are going to do very, very well over the next period, and benefit from the fact that, wow, we survived what was a very potentially kind of destructive period at certain points in time. We maintained our core value system and our value kind of proposition to the market, and now we're benefiting from from operators that I think were a little bit more hype and go away are kind of coming off the market now. And we're seeing that. We even saw that with kind of the difficulty adjustment on Friday.
That was so perfect.
Okay.
Yeah. The only thing I would add is what Rory eloquently described is there is moments of cyclicality but not secularity, meaning this is just the business cycle. It's evolving. Where you say burn it to the ground, it doesn't feel great, but it doesn't mean it's over. Secular means this is over. And so if the industry really wanted maturation and institutionalization, these moments of cyclicality are expected. Boards are discovering different things. Goalposts are changing for these companies. And so I think just this natural evolution is totally normal from my perspective, but it hurts. It's not fun. That's why having a liability forward, a problem-solving approach to your balance sheet is just perennially, in need during these moments of evolution.
Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. Ellipsis Labs brought capital-efficient order books to Solana and started the prop AMM revolution with SolFi. Altogether, they've saved retail traders tens of millions of dollars by reducing slippage on spot markets. They're bringing the same level of expertise to perpetuals with Phoenix, which is live today. Ellipsis Labs is backed by Paradigm, Electric Capital, and Han Ventures. I would consider them the foremost experts in crypto market microstructure. The best part is that Ellipsis Labs is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer looking to work with a DeFi team that's already proven itself in the market, go to ellipsislabs.com/careers.
AI has definitely taken a lot of the mind shift, but with regards to Bitcoin and mining specifically, this like data center discussion, right? And you've seen a lot of companies pivot to, well, it's kind of a spectrum, but it's been either full blown, we're going AI, or we're doing some combination of both. Maybe I'm curious, like how successful do you think this would be? I think, Rory, there was a little bit, I don't want to read between the lines. There was a little bit of kind of an implicit, sticking with core values and what you are good at, like where you have a competitive advantage is companies that will do well. And yeah, that you've definitely seen a lot of so I guess what I'm asking is, I don't know how much of it is hype versus how much of it is real. Like how well do, especially these Bitcoin miners with PPAs or with, dedicated data centers, or they generate their own energy in some capacity, they are talking about, moving over to AI and either pivoting entirely or some spectrum. Tell me how real this is, maybe. Like, is this a real thing, or is this mainly playing into the hype of, oh, we have energy and we know how to plug in computers, right?
Yeah, I want to kick it back to Chris in a second. So sorry to kind of keep talking over it, Chris, but it's very real. Or, we were just in a meeting yesterday, and our Jeff Thomas, who's ex-Humane and has been which was the kind of Saudi sovereign AI DC arm, and we were fortunate enough that he joined us at CleanSpark. He basically comes in every week and he says, it's still real, still there, it's still crazy, there's just not enough capacity. There's a lot of capital chasing it, there's a lot of interest, there's a lot of demand. And look, I use AI every day. I think people are going to continue to use those tools. They continue to grow, and we are constrained by atoms right now. So yes, it is very, very real. What I would tie, and this is the part that I haven't seen people talk about really, is that there's two different things, which is one, why will a Bitcoin miner be able to compete in this space? Well, one, let's talk about CleanSpark. I don't want to talk about everybody. The CleanSpark way of doing things is that we build deep relationships in local jurisdictions with communities that want us there, and we play a long-term game where everybody wins over time, and that's been very, very successful. So we did it in Georgia. I was at Grid, which was acquired by CleanSpark, which was running kind of the same playbook in Tennessee, similar geographies. We call ourselves kind of America's Bitcoin miner. That ethos of being there with people over many cycles. So energy is local. You really do need to know who, the people at the utility. You need to know the local council people. You need to go to the meetings. You need to hear the concerns of the citizens. And sometimes you need to add a little bit of investment that maybe if you're just looking at your Excel model doesn't necessarily pencil out, but it does. And so I think you can apply that skill set to going and finding PPAs and energy sites that fit this other kind of expansive profile. And then the last thing is that they don't necessarily compete with each other, right? For Bitcoin mining, like we've been pretty vocal that Sandersville is one of our marquee sites. It's outside of Atlanta, and that's really what you look for with an AI DC site is you want to be 100 miles outside of an NFL city. You want kind of fast fiber and you want kind of big footprint. For Bitcoin mining, it's a hub and spoke model, I think, right? There's these less competed sites, 25 megawatts, 50 megawatts. Maybe the transmission the transmission into a major population center isn't as developed. And so I think there's really an opportunity to, one, at the site level for these big AI DC sites, well, you need to do this thing called critical IT load, right? So if I have 300 megawatts, I can really only guarantee you 200 megawatts. What am I doing with the other 100 megawatts the whole time? Well, they're paying me for it because they need the 300 megawatts of critical IT. But if nobody's touching it, maybe I can mine a little bit Bitcoin with it from time to time. And then the second part is that I think you can move into this kind of hub and spoke model. And Chris, from your side, as you're seeing kind of people, and so we are very clear that it's an expansion. It is not a pivot. This is an expansion of our business. We are going from monetizing Bitcoin to monetizing megawatts. And we start at the Electron. We turn it into Bitcoin. And then we turn that Bitcoin kind of back into more money to fund our business back on the Electron side. And so I just think it goes all the way through personally.
Yeah, I want to go on the record first by addressing something that's been bothering me. One is this is not my living room. I don't have a grand piano. I am a boomer, but not this much. Yeah. This is just the amazing AI virtual world that we're in. Number two is, and I've said this before publicly, there is a world where Bitcoin is the return on equity hurdle, the hurdle rate for computational power. Why? As Rory elegantly described, the toggle between those two are so interlinked at this intersection. I love this podcast by a TradFi firm called Morgan Stanley, Thoughts on the Market. They had an AI panel, and the equity research analyst on AI mentioned Bitcoin miners. That to me was a profound statement at a time where Bitcoin's in a bear market. Okay, so they even recognize it from an equity analyst perspective, this toggle. The other thing I would say is what Rory is saying when I peel back the onion a little bit, bigger picture is responsible executive suites have to go and listen as a fiduciary for shareholder dollars to the highest multiple activity that they can get. It's 100% natural. In fact, it's their responsibility to do it. And so if they have sites that are worthwhile, they must look at it. And that's great. I want those firms that have high multiples because that makes them more sustainable, right? So that ties into, they should be doing it anyway. And lastly, and I don't want to be all, I'm a pretty balanced person. If we work with you, you already know that. The hyperscaler demand is very real, as Rory said. Our clients sometimes can't trade in a week because they're just inundated with what they have to deal with the data center side of what's going on in life today. But that being said, these hyperscalers have had a history in real estate, okay? When hyperscalers and big tech, the Mag 7s were buying office space for their cohorts, they really crowded out big city office markets. There's a lot of case studies on what they did and where they pushed office pricing for that. Why? They believe in in-person, mind, creativity, and creation happens in groups, which is great. So you look at big cities in the mid-teens, they really drove office space kind of right into the office crisis. But in COVID, these hyperscalers and notably some more in the direct-to-consumer space really crowded out logistics. During COVID, it really reminded us that the last mile problem of getting your whatever you're ordering online during COVID to your doorstep, we didn't have enough of it. So they crowded into warehouses. And then there was that famous Q2 earnings where, I think it was Amazon announced that they were subleasing logistic warehouse spaces because there was excess supply. And then more recently, I think some of the AI firms have said, oh, we're going to pump the brakes on some of the data center build outs. Again, cyclicality, not secular. Okay. That puts this all together. They don't have they know the demand is coming. They just don't know the time horizon and the duration of it, which brings us back to, what people like Rory do every day of managing that cycle, managing treasury exposures through just their lens of what they need, not necessarily what they're forecasting, but what they need today. I love that expression, trying to predict what's happening today. So when I think about that stuff, it's very real. The pivot is very real for all great reasons. You just don't know how A to B is going to get there. Sometimes you actually go to Z first. So, and that's the life we're trying to navigate with our customers.
Yeah. Okay. Well, just because I'm very lucky to have two esteemed TradFi experts on here, I'm going to just ask you general questions about the market, a lot of which is sort of stuff that I read and try to interpret, and then often don't know, right? Like maybe how TradFi is approaching this or how real this is. Again, online kid. A lot of my perspective is derived
3 times
from...
long silver miners. Buy it. No, I'm just
exactly.
Sorry.
Exactly. No. But this is a good analogy for a lot of where I get my information. We are seeing a lot of discussion as of late about private credit. It's kind of interesting because about 6 months ago, there was a lot of discussion about tokenizing this, right? And me being fairly skeptical, I started to look into some of the, they're doing this on a small scale, right? Initially. But crypto people, I think, especially at this point, are fairly programmed to understand that oftentimes when TradFi, let's call it, is trying to tokenize something, there is some degree of, adverse selection. Why can't they sell this? Why can't they offload these bags? Why are there, these redemption requests, so on and so forth? Anyhow, now, fast forward 6 months, there's increasing talks of private credit. I guess maybe the first question is, how big is this at a practical level? Like, is this GFC level, bad debt? A lot of the private credit obviously is from these middle market software companies. And now we have Claude Code and everybody thinks that these companies are going to be supplanted. There's a lot of talk about redemption requests. I hear less about whether this is actually bad debt. I hear less about whether these companies can actually service this, these loans, or if it's just an overarching fear, redemptions are driving that. And then the big funds are having to, fill the gap or whatever. But again, maybe only partially your domain, but regardless, I have two TradFi guys on here. So I want to understand how you guys are approaching this. Is this a huge deal? Are we panicking? What do you think maybe now and then going forward?
I'll start by, Rory, chime in anytime, but I'll start by someone saying to me, there's only bad prices, not bad assets. So it's how was it priced at what level? And I would say this as a former institutional and investor and asset allocator, I would say that, we had concerns of private credit at 500 billion. We have private credit concerns at 1 trillion. The private credit market is somewhere around a couple trillion. Bank balance sheets are about 25 trillion in the US alone. This is where the transformation and the opportunity for private credit is happening. Direct lending based on regulations has been very hard. Banks don't want to take risk for various considerations, some of it very good considerations. So moving it to the private sector makes a ton of sense to me. If private credit was a situation where those who invested lost their capital, I'm okay with that. That's capitalism. That's how it's supposed to work. If there's knock-on effects to your question, well, that's more of a consideration. That's why I get to the bad price point. If we were really backing companies at really extended ARR valuations, as you say for software, now that's going to leave a mark, and it's not going to be fun, and it's going to, so in those moments of time, and actually we'll get back to crypto with your answer on this. In that moment of time, I think that's a problem, and that may force liquidations of good assets. But the TAM of it isn't consequential in a vehicle that's, I don't want to say ring fenced. When the GFC happened, banks are the free market insulator of shock. They're supposed to absorb risk. So it was hitting the banks at a time where, and in a capacity where they're supposed to be the insulator, and they can no longer function because the balance sheet's got impaired. That's not going to happen in private credit unless the existing investors.
Yeah, and post the liberalizations in the 90s, they had gone, you repealed Glass-Steagall. And so the commercial banks and the investment banks had become one. And so you also had retail at risk, right?
100% agreed. And so where do I fast forward this to how this is hitting software names? The stock market in itself is Everyone has a risk manager. That's a good thing, by the way. Everyone has a risk manager. It's a 4-letter word that everyone should have. But in a typical risk framework, you have a correlation or a covariance matrix. Some of them is 30 days, some of them is 90 days. If you're a bank, you have CCAR, that's 1 year look back on shocks over the last 5 or whatever years it is. And you have to manage those exposures. Where do I go to crypto on this? Well, this, I make the case digital assets is the first ever asset class born out of high frequency trading. The moment to moment, the nanosecond to nanosecond person. That is a real-time covariance matrix. So when they see NVIDIA stock down, they'll take anything that's correlated to it in any capacity and just derate it a little bit, and then derate it more and derate it more. So as you see the trickle down from the slower capital, because private credit, you can't liquidate if you wanted to. As you see the covariance matrix evolve from the 1 year people to the 30-day people to the 1 day person to the high frequency, intraday, is a broad statement person. You see these correlations start tying together. And so that's kind of where we are. And that, I think that describes the moment that we're in as relates to some of this stuff and how private credit is hitting it. It's March 25th as the recording of this podcast. March 30th is quarter end. It's typically a redemption date. I like that. I like the cleansing out of it. It can happen. That doesn't mean it can't sell off more. But these dates are very important because it brings to back what's happened day to day back to the person who operates on a year or a 10-year basis, the endowments, the family offices, et cetera. So we need a few of these cleansing cycles to happen through quarter ends and year ends and flush the system out. Once you write down a zero, you can't write it down anymore. You just got to take the pain to do that.
Just to extend on that a little bit, it's always hard to make prognostications, and I try not to. What I would say is I'll give you my intuition and my base case is that well, and to kind of go back to your point on bank balance sheet size versus private credit market size, and Gort, you'd said something like, is this global financial credit size or global financial crisis size? The answer is yes, and that doesn't matter anymore because the sizes that we're talking about in general are so much larger because, quite frankly, we've added to the monetary base so aggressively in the last 10 or 15 years. Credit creation has added so much. Linkages both from high frequency trading, electronification, global capital pools, like all of these types of things. So the actual headline number is probably about the same. I think TARP was like 700 billion, and that's like a weekend for Paddle right now. But like the point being that the linkages between private credit and the real economy, yeah, I mean, theoretically, private credit is a real economy because you're lending to these mid-market businesses. In regards to contagion, I think it's a much more contained thing. In regards to like the headlines on redemptions, it's really easy to say. So the way that these funds work is that because they're illiquid and that you when you put your dollar into it in the first part, they send you a big prospectus and it comes in the mail, and then you put it on the counter for about 2 or 3 weeks, and then you don't read it, and then it goes into the garbage, right? But like essentially what happens is they say you get to redeem up to 5% of your capital every quarter, right? And you don't get to do more than that. And so we've been at this point where people love the fact that you're getting 11% with zero volatility and total liquidity. And all three of those things don't work over a cycle, right? And so what we saw was that as some scares started to happen, the request for redemptions got really close to that 5% cap, and then they finally exceeded it. And then a few of these big issuers essentially said, okay, we're going to come up with some balance sheet cash, or we're going to do a continuation fund, or we're going to do whatever, and we're going to meet this just to like kind of assuage fears and do these things that are out we do not have to do based on our prospectus and don't actually match the return profile and the liquidity profile of the asset class, but we're going to meet it. And then finally BlackRock basically came out and set the standard and set the tone for the industry and said, nope, it's 5% redemptions per quarter. We're going to meet that. And you can do up to kind of another 2.5% without having to go to another tender. More kind of inside baseball, but it's sort of irrelevant. But we're going to do that. And then if you want to redeem next quarter, you want to do the next quarter. That's how it works. And that's how institutional investors work. You don't come to you didn't come to Discovery Capital and say, and obviously we would work with you if you wanted to, but the way that hedge funds work is high net worth individuals, institutional allocators. They put money to work in more illiquid vehicles that allow you to do things that can generate a higher return because you're taking on this liquidity premium, right? And so you have redemption cycles in hedge funds. You have redemption cycles in many of these funds. And this is the first time that I think retail has that kind of the ETF and the electronification of the market has really met the kind of the illiquidity side of the market. And so do I think it's a crisis? I don't want to speak too soon, and I could be wrong in 5 days or 50 or it doesn't really matter, but I don't really think it's a crisis. What I think is it's growing pains, to your point, Chris, on cyclicality of things. This is a cyclical business cycle within a secular trend of more people doing more investing, more things being available, more information, more access, and you're kind of meeting the limits of certain vehicles, what they can provide with the expectations of kind of the people that are investing in them. And I think that there's going to be a little bit of growing pains, but I'm not really worried about it like blowing up the global financial system. What we saw in the GFC was we saw recovery rates that were actually pretty high over a cycle. And a lot of these funds are trading at discounts to NAVs that are actually below what we saw recoveries in both the global financial crisis, COVID, and the Silicon Valley banking crisis. And so you're seeing these things get to marks that are a little bit out of whack. And so I just think it's a classic kind of there's a structural issue that people are running into, and they're kind of learning about this asset class. It makes a great headline to talk about redemption requests are above what the prospectus agreed upon redemption level is. And then you're getting the kind of AI, worries about all of this kind of fear within it. So I don't think there's going to be zero pain. I think a lot of the longer term kind of continuation funds that have been playing in the edges are from less strong brands, don't have as much distribution and kind of balance sheets behind them, and have less strong investor bases are going to wither away. But I don't think like B cred is going anywhere. I really don't.
Yeah. Okay. That makes sense. Okay. The last bit, let's kind of just pivot into what we said we're going to talk about mainly at the beginning, which is current events. So we can go for as long as we want here, but maybe Chris, what are clients coming to you for right now? And say this in the context of, we're in a war with Iran. There's a lot of screeching everywhere. And what are you seeing? What are you structuring? What are clients coming to you for? This could be miners. This could be, people wanting to sell cover calls on their tokens or whatever it may be, right? I'm curious, what are you seeing right now, specifically with regards to the market environment?
Yeah, look, we always try to quantify of what's left in the market to gain. So risk premium. Risk premium means if a stock price should be at 100, but for whatever reason it's trading at 96, there's $4 of risk premium to be gained. This is the opposite right now, where protection is very expensive. Naturally, we had in the crypto world, if you're trading Bitcoin from a number of different angles, we've been in since 1010. So we've been saying actually the risk premium on put options, i.e. the price for insurance, is really high. And actually going into the attacks in the war, that was kind of the highest point for us. And we actually said the opposite. If you're looking to hedge yourself, these are not the droids you're looking for. This is not going to help. So we're actually seeing the opposite, where look, let's be thoughtful about your portfolio. If you need to hedge at the low, I got other things that you should probably look at, but I want to understand what you're trying to solve for. And so actually we've been monetizing puts this whole time. We don't like them. Just like in the GFC, protection becomes behavioral. My chief risk officer, my job, my boss will fire me if I don't protect the portfolio. Well, that's too late. So you should do it, but I'm going to sell that to you, and other clients are going to sell that to you, and the market's going to sell that to you, because those are put options that only a very finite probable outcomes can that help you at this price. That's why I go back to there's no bad assets, they're just bad prices. So we're actually structuring, getting people ready for the long side of it. We've had a 6-month bear market or 5-month bear market. We've had some really catastrophic events. Price is holding in there. In fact, our weekend note last week was actually in March. Bitcoin's up. Yeah, Bitcoin's up 6 or 7% rather than and SPOOs and S&P and Momo and equities are down. So actually, I'm not saying we were first to lead, but maybe the de-risking for other reasons has already happened, and the price for insurance is really high. I do not make price predictions. I just look at risk premium of the market and forming my opinion on like, is that a good risk reward or not? Put options have not been a good risk reward. And so we lean into that. Now that may sound very bullish, and that's to the listener to hear, and we'll work with solutions in it. So we're really trying to look at put options, understand the portfolio, and come up with different structures to make the net, if the war prolongs for a year and oil prices stay high and we're in this, they can survive. But what I don't want to happen is nothing change over 6 months. We just whipsaw around and you just let a lot of time decay, because I told you these put options are very expensive. They're not cheap. And then it'll flip. So we are restructuring portfolios pretty actively here to try to best put them in a position to not just survive a volatile tape, but also to capture some risk premium, whether it's expensive put options or, as you mentioned, call options. So the overall level of volatility comes high. So actually, call options are actually back. They look good to sell in terms of call overwriting. You just have to like the price you're going to get out at. So that's kind of the general thesis of the last couple of weeks.
Let me, because you touched on it, 1010. I've talked to a number of more crypto native traders, not saying aren't, but just because I put you more in a TradFi category here, given your experience. I've talked to a number of, more crypto native traders, and I think a lot of people are still sort of dumbfounded by 1010 specifically. It really was kind of like a paradigm shifting moment. Did you have any takeaways from that? I mean, I guess there was a lot of speculation about what happened on certain exchanges, and just curious, like from your perspective, what happened on 1010, or if you had anything like really an interesting takeaway that maybe I wouldn't hear from somebody who was, licked on 50x on Hyperliquid, right? Like that's one perspective, and I've heard that a few times, right? But maybe from your view, what happened during 1010, and how did you guys approach this?
Yeah, I'm going to have a very boring answer for you. We won't trade offshore yet. We don't know what the exchanges are. We don't have liquidity. They don't want U.S. persons. We're unabashedly American. Even my UK office reports the American office here. So we follow Dodd-Frank.
Shed is spiritually American. Come on now.
So it's eye-rolling to talk about your legal framework, but it's really important from protection of my clients' flows, my clients' assets, and how we operate. Now, why do I say that? I did a call a couple years ago with a guy with 3 degrees from MIT in computer science. He's like, have these protocols and exchanges. I have 3 computer science degrees. I can't figure out from MIT. I can't figure out what I'm doing here. I'm like, well, I'm not going to trade on this. If you can't underwrite where you're trading, how you're trading, and what is happening, what are the protocols, how the algorithms work, you shouldn't trade there. That was my takeaway. And we did it again. By the way, we saw that obviously in the aftermath of FTX. LBT Terra Luna was part of that. So my takeaway was where you trade is as important as what you trade. But 2 is something very bad happened there for sure. As someone who managed a high-frequency trading business in TradFi, when you see certain exchanges go down more levels than the market aggregated price, that is mass liquidation given their collateral protocols. That is not a place that's going to be friendly. And so we had to reassure all our counterparts we don't trade offshore. We had no impact. But that just tells me that we're not mature yet. We're talking about being a mature industry. We're just not there yet. So sometimes regulation is your friend. But that's my takeaway. I think there are bodies that are being covered up. I think the market will move on. But I think some real damage was taken. Thankfully, none of me, ourselves and our clients weren't damaged. But maybe that's a self-selected audience that work together. But real damage was done. Real balance sheets were impaired. No question about it. I don't really know much more other than that. Maybe Rory has some further insight.
I have some hot takes, but I want to start with kind of the top level, which is, again, agree with Chris's frame, right? Which is that, and which is one, just the general approach to let's be thoughtful about what we're trading and how we're trading and who we're trading it with and what our expectations are. So what happened on 1010, to my estimation, was we've been watching this IGV software ETF now correlation with Bitcoin for a while. If you look at a bunch of TradFi markets, they actually had turned about the week before. And so things had already started to turn in macro and TradFi before 1010 happened. 10/10 was, I think, Columbus Day weekend or something along those lines. It was a U.S. holiday. It was a U.S. bank holiday going into Monday, so it was a 3-day holiday. Market had turned. You got to remember what had gone on that summer, right? It was paper Bitcoin summer. It was DATCO treasuries. It was quantum insanity. It was, and I talk about, do I think AI is real? Yes, absolutely. And the demand is real. But some of the SMR companies, some of the this and that, some of the long tail stuff with very long kind of, with basically a PowerPoint deck and nothing else. We're trading at kind of insane valuations. That had been going on for a while now. And while the market had started to turn, then we got this headline into this long weekend after TradFi had already turned, and we got this wick down in kind of Bitcoin and ETH. And then that piled on to a lot of the other stuff that was going on. It went into the ADLs between all the perp stuff, because perps had become a much larger part of the market. And so what people don't what I think people, and I actually certainly learned a lot about about perps and the structure, market structure coming out of this. I don't want to profess to be an expert going in, but I've learned a lot about it, which is that it is really a one-to-one market. And so for any long, you have to have a short. And so they have these automatic deleveraging protocols that basically takes these pieces out. So when one piece goes fugazi, it automatically closes the other side, and then a lot of people are basically trading these perps across exchanges and trading kind of this spot perp arbitrage. And then what happens is you're naked on one leg. So then you got to panic. You got to run into illiquidity on a 3-day weekend on a Friday after TradFi markets had already changed, and you got to start to close out all these other legs. So no, I read the piece by this guy, and it was like, oh, there was a Hong Kong hedge fund. They were long silver, they were long AI, and then they were cross-margining it with this, and they're doing that. No. That is what happened, but not because some centralized Hong Kong entity, hedge fund or whatever, was doing this. It was a bunch of other insanity in the market that all kind of led into these pieces across all of these different kind of implications into a holiday weekend. And then lastly, I'm not a Bitcoin maxi. I'm very long I'm long America. I'm very long innovation. And I believe that smart contracts and securitization and stablecoins, all this stuff, I think is net positive and very, very interesting. That being said, Gwart, if you're a crypto native, and I can see Gwart, by the way, he's actually smiling. He doesn't do it often, but but I think he knows what's coming. If you are a crypto native trader, are you really that shocked when Fartcoin wicks down 70%? I mean, is that like a super shocking outcome? I'm sorry to call it out like that, but you're talking about meme crap with no revenues, these esoteric protocols that nobody understands, high hackability, offshore exchanges or decentralized players, illiquid markets. And I'm sorry, I'm just not that shocked when stuff that has absolutely nothing behind it, no business plan, no team, no community, no cash flows, starts to trade in these extremely volatile ways. Now, so I don't want to minimize the damage. I think there are bodies. I think there is damage. I think there are real players that wanted to bring in institutional risk management, kind of institutional way to do these things, that got caught in some of this stuff. I think, some of the trading desks are going to have pain, and people are kind of working through all of that. So I'm not trying to minimize this at all, but I'm just saying that it started over the summer with a lot of the kind of hype going on. TradFi markets had turned. We had a very specific incidence of kind of a low liquidity weekend with a scary headline, and then you had a market structure issue in this new development of this rapidly developing perp market that kind of forced this deleveraging across a long tail of assets that I'm not making a price prediction one way or the other on Shiba Inu coin or whatever.
Yeah.
But it's just I'm just not shocked by it.
No, well, I will say, okay, so I will say one thing. I don't think any of us were particularly, surprised with Fartcoin wicking down. And then there was other, Fartcoin's a funny one, I suppose, but there was some, projects with legitimate backing that absolutely nuked. To me, I was less surprised about this. I was a bit surprised to see Bitcoin wick down 20% on some exchanges in like 30 minutes effectively.
Yeah, fair enough. And I felt that, but like to Chris's point on like currency crisis, like I was on the desk when Euro Swiss depegged, when Swissy depegged to the euro right ahead of the ECB going on into QE. I was on the desk when yuan, China yuan spiked up and that kind of thing. And I've seen these multiple times in TradFi markets where you get this wick down, it's a big move. These things are supposed to trade like Euro Swiss is supposed to trade with like a 3 vol, and like it wicked down 24% at 3 a.m. And I'm on the phone with our portfolio managers kind of talking through this stuff. So yeah, like it's a big thing. It also, but that's what happens when you trade, when you have a truly free capital market that trades 24/7, that is subject to all these things.
To both your point, I read something. I just want to, I don't attest to its veracity, but I think it'll rhyme here. 20% drawdowns in Bitcoin in the year 2020. There were 4 of them. The average number of days for recovery was 54. 2021, there were 7 20% drawdowns. Average days of recovery was around 100. 2022, we all want to forget 22 and 23. There were 11 20% drawdowns. It took us 323 days to recover. I think that's probably 20,000 or 17,000 to 16,000 and recover. In 2023, 0 20% down news. 2024 ETF 0 20% down news. 2025 0. 2026 we're in one. So what I would say to this is the institutionalization. We're getting numb to the fact that it's becoming less volatile. So when it happens, it feels
right. Exactly.
It feels more. Yeah.
The stocks are down more. Again, it's just, it feels bad when you see it happening. But again, to me, that's kind of the beauty of this free market, is that it does trade on the weekends. And that's why I think it's such pristine collateral, because down 20% really, really hurts. But what hurts even more is not having access to your collateral, not having access to your risk management, et cetera.
That's perfect. I think it's annoying, I guess. So I wholeheartedly agree. And right, we like oftentimes are revisionist, all that. We're accustomed now, we feel accustomed to this dampened volatility. And so when it does happen, it's, it is cataclysmic. But I will say that the unfortunate part from my perspective, it's like almost saddening. I've talked to people about this, is these type of things. And this is unique in some sense because Bitcoin is probably the purest iteration of a free market asset that we have. And it has a reputation, right, of being volatile. It has a reputation of being scammy. When I see this, it's unfortunate and, again, somewhat saddening, because this to me does unfortunately delay adoption in some capacity. Like, people don't want to be, and that's just the reality. Again, like, these are all things that we internalize, and none of it we've held down in crazy drawdowns, right? So all of this stuff, but when we see and granted, maybe it was all fluff and maybe everything has been fake. The entire world of financial markets have been fake for 5 years now, but the reality is when we see some positive regulatory change, when we see, the president, I'm doing this a little bit, tongue in cheek here, but supporting Bitcoin in some capacity, we see these, improvements. And then we see this 20% drawdown. The people we are hoping to onboard, the people that have onboard, they're already onboarded. And most of them have experienced this and they know what they're getting and they're in it for the long run like we are. But this cusp of the new entrants, this type of stuff does delay adoption. And I was talking to people, who are building semi-custodial or non-custodial lending protocols. And we're sitting here calling Bitcoin pristine collateral. It's very hard to say that to somebody who, works a 9 to 5 and you say, borrow against your Bitcoin, and then they get some 20% drawdown and get liquidated. Like, we're not quite at that point yet. And that's, to me, where it's just like this type of stuff. I obviously in the very long run, I'm as bullish as anyone, but I do see these moments. I think, this delays adoption a bit. People are going to be skeptical of things like this. So that's my only kind of reservation.
Corey, you're hired. That is the EDG value proposition
for you guys.
that is it. Just because it's volatile, it'll slow down adoption. So we can help you manage that. If you tell me, and this was a real scenario, if we're building dollar repo, which means nothing, general conversation in life, on ETH rails, but ETH is a 80 volt asset, and you have to pay gas fees every time you do a block, but you don't know in dollar terms.
Right.
You don't even know where the gas fees will trade on the next block, and it's an 80 volt asset. How are you supposed to build the world's backbone of financial markets on something where you don't know the cost of trading on it?
Yeah.
Right. So that's where treasury management comes into play, is help people with manage volatile assets so they can, forward plan their lives. But we totally agree with you. And that's exactly the thesis of what we're trying to help people with. And those are real scenarios. Those are not make-believe scenarios. Like the banking system is looking at SOL, they're looking at ETH. It's, to your point, it's kind of hard to take it to your investment committee or risk committee and say, hey, I want to build, dollar lending on this token, but it's 100 vol asset. Well, we can actually help you manage that. But that is we're right there with you.
Yeah. Well, I guess the last thing I want to touch on, and again, this is just very broad market thoughts, and I may have some opinions and you guys may be more tactful with your responses, but I want to ask, just given current events, we look at traditional markets and it's just it looks like a lot of times it looks like a charade. It looks like a circus. It truly looks like markets move only when the president tweets something positive or perhaps something that could be interpreted as negative. And I was making this joke, like we're all, a bunch of 20-year-olds saying we're living through unprecedented times. And it's like, well, of course, unprecedented. You're 20 years old, right? But we're young kids who haven't seen, decades of traditional markets function. But this stuff does seem very out of line. And, we see these little headlines, like somebody made half a yard on some poly market bet. And we see people front running these Iran, negotiations or fake announcements of negotiations, whatever they may be. And it's like, it does kind of worry me. I mean, to the extent that I worry about this stuff, which it's not clear how much it affects my daily life, but like looking at just maybe not so much me, but just how generations of new entrants are looking at capital markets, it's unfortunate, but like everybody you see thinks it's all fake, right? And it's bizarre. Now it's like, to me, this is the first generation where we think everything is fake. We think everything is narrative driven. And I'm curious if maybe like how real you think this view is. It's not necessarily mine, but I share a lot of the sentiments. And then two, like, is this the future? Like, is this going forward? Is everything predicated on Twitter headlines? Is all the money fake? Are there insiders front running everything? Like, is that a real thing? I don't know. It feels late stage capitalism at times. It really does. It feels like the end of the fiat monetary order. Like all these things we hear about, the hyper gambling, like people have written about this, right? This is nothing new. They talk about this. So I'm curious, like TradFi perspective, how much of this is real, and like, how do you guys approach this? Perhaps whoever wants to go. I want both of your opinions. But whoever wants to go first, whoever wants to give the hottest takes.
No, I was just going to say we got through an hour and now it's time for the next 3 hours, because I do think that this is like the topic, and I actually, to the degree that you would be interested, I would love to spend an entire episode on this. I think it's extremely nuanced. I think it's extremely there are kind of like a lot of like both things are true at the same time. So let me try, Chris, if you don't mind, maybe I'll try to attack it real quick. So, is everything bullshit? Yes. Okay. And also it's the same amount of bullshit it has been throughout human history. It's just a different flavor and style of it. It's also true, like in the both things are true category. Things that are frustrating to me or interesting that I started to identify many years ago and have designed my life, career, philosophy, and investing around are: one, hypercycle theory, which is that things are going to happen faster and faster and faster. And I think that we've seen that. I think we've seen both things go up and things come down faster. I think we've seen narratives gain traction and we've seen narratives lose traction kind of faster. Now, when they were trading under the what is it? Is it the baobab tree? What do they call it? The Economist has a great column on it. They call it the baobab tree or whatever it was. And it's basically this tree that was on Wall Street that everybody used to come to, and they would just exchange pieces of paper. They would trade under it. Were things like, were things more real then? You had no information. You had no ability to contact people around the world. You had no ability to kind of disseminate these things. You had no ability to verify them. it was less volatile in the way that private credit's less volatile because there's less information, but it doesn't necessarily to me mean it's any less real. I'm absolutely I'm in this space to be a good, transparent, high integrity actor. And so I do not ever want to minimize any of the stuff that goes on around the edges, both in this industry and adjacent to it. It's fact, I'm driven to Bitcoin because it's open, transparent, permissionless, and 24/7. And I think that it is crying out for people that have a real value system to bring that value system to it. So I don't want to minimize it. But that being said, in the days of, so there's a great story about a manager, and I'm not gonna say who it was, just because that would give away a little bit too much. But back in the day, they used to fax out the economic releases. And what this manager figured out what they would do is they would do it alphabetically. And so he named his firm, and it starts with an A, and let's just say he's a billionaire. Okay. And he's unbelievable macro trader, has been in a million different things, has done all this, but he also had this insight at one point in time that, early on in his career, that I get the economic data first because the name of my hedge fund starts with an A. And so there's been that kind of stuff. And you could go back to journalism and things and this and that. And I just think that this stuff has been there. One of the things that gives me hope is that, gosh darn it, at least now it's out in the open. People are just brazen about it, right? And you see it in the way that, and not to get too much into and again, now I'm on soliloquy, I'm on my soapbox, but you've seen it in the breakdown of the social compact since COVID. You've seen it in the way that people act in public. There's a breakdown in kind of politeness, and I think in kind of communal kind of aspects of how people deal with each other and how they think about how they affect each other. So I think you see it there. I think you see it in people kind of going back to that kind of old American style. You got to remember, there's a reason that there's a term called snake oil salesman. That used to be one of the main professions in America. So there was a lot of that kind of stuff in early American culture and ethos. And it feels like we're returning to that a little bit. So I'm here to stand against that, quite frankly, that wind and that wave. And it doesn't scare me in the sense that I think that what you're seeing is human nature be transmitted through the mediums of technology and the cultural moment that we're in. I don't think human nature has changed. And then what grounds me in why we're going to win with this permissionless global emerging monetary alternative that is pristine collateral, that allows people to participate, and that over time, good actors, again, going back to that tortoise and the hare, good actors are going to win over time. Why I don't get concerned when it feels like a narrative gets away from me, and why I don't get too upset when it feels like things are kind of in the dumps. And this is very personal, and this is purely me. To be very clear, this is purely me. But I have a very strong faith that grounds me. And that faith is that it essentially comes down to things that are impermanent will be impermanent. And I've seen this throughout, and I hesitate to say this. I've never said it publicly, but my faith grounds my investment philosophy in a very core way, because I've seen this play out in the markets over now a decade and a half, 2 decades. I've seen many cycles that are clearly unsustainable. They reach a level of unsustainability, and then it goes all the way back to the other edge. And the person building over time, investing in relationships, investing in risk management, investing in, investing in business models and margins and efficiency and all of these kinds of things. Eventually, look at Jensen Huang at NVIDIA. I mean, that was a stock that they were fine for a long time, but it's just took him 20 or 30 years, and then he really, has it's a 100x, and I see that many times. And so I think that I'm glad that your generation is asking these questions, because I think they're very, very important. I think it's a part of the journey of engaging with. You kind of go through the jadedness of and I'll just finish with this. And I'm sorry, I'll finish with this, which is that when I was a kid, I still remember when I stopped going to the carnival. Because you go to the carnival and you get on the ride and you think, oh my gosh, the adults are in charge. It's safe. It's scary to go up on this roller coaster, but the adults are in charge and it's safe. And then you get to like 16, 17 and you realize who those adults are. And you're like, oh my God, the adults are in charge. And so yeah, it's horrible. And so then you go back to the like, okay, maybe I'll go on this one and not that one, and maybe I'll still take my kid, and maybe I'll do this and that, and like you kind of go through this journey in life. And so I don't want to minimize the fact that it does feel like we're in an age of grift, and I think that is I really don't like that at all, and I want to stand against it. But I would say that my experience, my study of history, and my grounding in my faith and kind of how it applies to the world have been the frame that I use to kind of live my life. And it's worked for me. And I think that others who find their own version of that, it will work for them even within this day and age.
Well, I guess, okay. So I wholeheartedly.
Sorry, Chris, I took all of your air. I'm so sorry.
We'll definitely get Chris's final thoughts on it. But I just wanted to state like one thing, and I need to be tactful with how I say this because I really do try to stay out of politics in general. But I do wonder, I first of all, like I said, I wholeheartedly agree with everything you say, and I think it's actually an optimistic approach. And I'm also generally optimistic just about human ingenuity, let's call it. And I think things tend to work out because a lot of people want to keep the world alive. So this is like the overarching theme, and I think that is sort of what you conveyed. That said, one thing I struggle with is people talk, well, there's always been insider trading, and we're just seeing this in a more because information disseminates so quickly, and because we have all these different asset classes now and like poly market, and because we have the ability to see some of these things transparently, like for example on Hyperliquid you can see some pretty interesting trades, like so everyone says this, but I guess what I am less certain about is like, and again you can decide depending on your sort of political lean what you think of this, but 5 years ago or whenever it was, there was this incessant castigation of Hunter Biden for having some loose attachments to some company in Ukraine, right? And this was like a huge ordeal about how, this was a political, disaster, and this is corruption at its highest form. And now we have the president launching like literal meme coins, multiple literal meme coins. And I just think it seems like we've really gone so far on the spectrum, and we're trying to conflate, well, there's always been this, there's always been that. It's like, okay, where do you reach a point where it's like, okay, this is not great? And I don't know what that point is. And I'm not even really trying to imply anything about, president or politics in general per se, but I'm just thinking back about like, okay, the Trump family has admitted to making billions on crypto, and like, Hunter Biden was screwing off and doing crack and like, had some affiliation with this, Ukrainian miner or whatever. Like, he's like, come on, at least let's not.
Come on, Gore, throw us a boat here. We can't. No. Can we throw us a boat here, buddy?
I don't have to like. I really don't like. I don't have strong feelings about this one way or another. I mean, I'm being earnest. I would say if I did, I don't have anybody I can't like. There's no one who I have to appease, really, right? So I would tell you, but I'm just saying that it doesn't look great. And like, I was very optimistic about Trump supporting Bitcoin. And, this is the stuff that over time, like I was saying, like as optimistic as I am that you're right, that like long-term value oriented people who are good in society ultimately win. If we have built an entire generation that just thinks grifting is the norm, it's not like, I don't know. At the very least, it seemed like this mentality could take a long time to come out. Okay, Chris, yours are.
It's all you.
You have to finish up strong.
I'm gonna actually kind of put your two thoughts together. Number one is, in this information age, we've gotten to such transparent information on so many great things that maybe some people take information either for granted or they're entitled to it. Information is really hard to get. The best hedge fund managers in the world work really hard to get unique information. That's not illicit behavior. That's just research. And so in this information age where everything's so prevalent, it's just shocking that, someone has an edge on you. And I think that's just maturation and investment careers will change, and that you'll understand that information is actually not an entitlement. Number two, as I would say, is there's an investing market and there's a trader's market. Information tweets, to your original question, will have a broader impact in a trader's market. We're in a trader's market. A tweet like that won't matter in an investing market. We can talk a whole nother podcast on that, but that's my two thoughts on that. And I've really enjoyed this conversation. It could literally go 9 more hours, but yeah. I thanks so much for your time.
Yeah, thank you guys. Thanks for coming on.
Thank you. Appreciate it.